Good day everyone, and thanks for joining me on another episode of the Mortgage Chat. Today we're going to drill down and dive into a real life example on what we've just done for one of our clients in purchasing a property under the SMSF. So lately I've been getting a lot more inquiries, and what I've been getting the most is people asking for certain scenarios and certain breakdowns with a super balance of between $300,000 and $350,000, and also with an income of around $100,000 for them and their partner. So I thought, you know what, today I'll do a real life example on what we've just done for one of our clients, which matched a lot of the inquiries we've had through our social media platform. So let's get cracking into this, right? So they got a combined super balance of $335,000. But the thing is, we want to leave around $35,000 for a rainy day in case anything happens to the property. So what we want to do is we only want to use $300,000 off it. Now their income is $110,000, paying 12% super, and $90,000 paying 12% super. Now this is actually a very good example, because with this super balance and with their borrowing power and the proposed rental income, they can actually buy a half decent property for $700,000 with a low LVR, and I'm going to break it down for you in a second. So their borrowing power was actually very close to $500,000, but there was a reason why we want to keep it at this breakdown, and I'll show you why. Now let's just drill down on the breakdown of the purchase price and setup costs. So they're looking to buy in Queensland, okay, and they want to buy something for $700,000, and they want to use a super balance of $300,000. So the stamp duty for a $700,000 property is just under $26,500. Now after solicitor cost, after changeover cost, after setup cost from the SMSF, bank fees, valuation fees, they're going to use up around $35,000, and the remainder, call it $260,000, will be used for the deposit, and that is why they're only borrowing around 62% of the purchase price, okay, which is a very low LVR. Just ignore these two sales for now, okay, because these two equate to $35,000, which is the money they want to keep in the industry super fund for a rainy day. Now, why do I have these? Well, it's because some banks require a liquidity ratio, which is 5% of the loan amount. So for argument's sakes, right, if I want to use $315,000 for argument's sakes, that becomes a negative. So this lender would not accept it because there is no 5% remaining in the super balance to cover the loan for a rainy day. Okay, so for this particular scenario, just ignore it for now, because we have more than 5% for liquidity. That's why we have this amount here and this amount here. So this is the breakdown if they were to buy something for $700,000 with a loan of just under $435,000. Okay, so come across here, this is the loan. This here matches here. Okay, now I've used the rate of 7.25% P&I. So the rate difference between an SMSF loan and a normal residential investment loan could be anywhere from 0.8 all the way up to 1.5%. And that's what scares a lot of consumers out there, because the rates are actually quite high. So unless your asset here grows significantly high in capital growth on a long-term basis to absorb this high interest rate, then guess what? You sort of don't want to buy something under the SMSF, right? Because it is a bit risky. But who am I to tell you what to buy? All right, so you buy whatever you want, okay? So let's work out the repayment and the cash flow for this investment property under the SMSF. Now, remember the loans here, which equates to here, a 7.25% over a 30-year loan term, P&I repayments is just going to be under $3,000. We are assuming rent is $500 per week. Now, monthly rent will equate to $2,166.67. All right, so we're going to allocate 20% of that income for expenses. So what do we call it? All right, property management fees, council rates, water rates, insurances, maybe some repairs, okay? It could even be 30% at times, right? So you know what? For this example, let's put it at 30%, okay? As a worst case scenario, let's put it at 30%, all right? Because you purchased an older house that may require some more repairs, all right? So 30%, so $650 minus that means your net rental income after expense is $1,516. Okay, that minus your repayment, that means this cash outlay from this SMSF loan, you're short $1,450.27 per month, which equates to $17,403.30. Now let's go down here a little bit more. Okay, so you also have to account for SMSF fees, right? So every year you have to do accounting, financials, tax returns for that SMSF. Now, it could be 1,800, it could be 1,500, it could be all the way up to 2.5 grand. So let's just use 2 grand for now. Okay, so annual fees. Some lenders charge it, some lenders don't. I'll just put $395 as a worst case scenario, because you want a SMSF loan that has an offset account for argument's sake. Okay, so most of them will charge $395. All right, so the cash flow plus the yearly costs, your out of pocket is going to be $19,798.30. So who's going to cover this shortfall? This is where your super contribution comes in. Okay, remember your employer super contribution is 13.2 and 10.8, so which equates to 24 grand. All right, so that means that minus that, you're left with $4,201.70 in excess. Okay, so what can I do with this $350 per month? Well, there's a few things you can do. You can pay it into your loan so you can pay down the loan faster. You can put the money in the offset account to reduce the interest organically. That will pay down the loan faster. Or do you know what? You can use the money to invest in stocks, ETF, whatever you want to do. Okay, there's no restrictions on what you want to do as long as it's within the ATO guidelines. All right, so that is the breakdown for this particular client on the purchase price, the borrowing power, the cash flow, etc. Okay, we didn't want to stretch the clients too much because we want to keep them a little bit of a buffer. We didn't want this to be zero, obviously, okay, because that means they're not paying down the loan faster, right? So at least in this scenario, they can pay down the loan faster by $350 per month. Now I'm going to show you a quick example what will happen if they allocate this extra $350 into the offset account or into the loan amount as an extra repayment. Okay, everyone, so let's see what will happen to your loan when you actually put that extra $350 into the loan or into the offset account and how fast it actually pays down the loan by. Okay, so this is my website here. You can go into the calculators, you can go into extra repayment calculator. All right, now the loan is, let's round it up to the nearest thousand, so which is 435,123, and the rate is going to be 7.25%, and we're going to make extra repayments of $350 from day one. Okay, do you know what? Actually, let me show you this. So if you were to make the bare minimum repayments and you were to invest that extra $350 into stocks or ETFs or whatever you want to call it, obviously it's going to take you 30 years to pay it, assuming the rates don't change. Okay, so what's going to happen if you actually throw in that extra $350 into the offset every month? Let's see. Look what happens right here. Okay, the loan goes from 30 years all the way down to 22 years you're going to pay it off by. Okay, so obviously, if the rates change, you'll probably go down a little bit more. All right, so that essentially saves you 8 years and 3 months from the term of the loan, and saving you around $200,000 in interest. Okay, so that's why sometimes it's actually a little bit more better to pump the money into the offset or into the loan so you can pay down the loan a lot more faster, especially when the interest rate is 7.25% like right now. Okay, yes, maybe you can throw in stocks and you can earn, call it 10, 11, 12% in growth, but there's also a risk factor in that as well. Okay, in here, the money that you put into the offset account, there's no risk in there, right? It's pretty much like a risk-free return because you're not paying interest on that loan. So there you have it, everybody. So this was actually a real life example that we've just done for one of our clients. Okay, now if you have other scenarios or other questions about certain SMSF, please reach out. You can book a time in, you can send me an email, and we'll try to get back to you ASAP. Don't forget to subscribe and watch all our other videos, and peace out, and thanks for joining me on another episode of the Mortgage Chat.